Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Hey everyone, and welcome. Today, we're going to pull back the curtain on one of the best-kept secrets in personal finance, the saver's credit. Seriously, think of it as a hidden bonus that can give your retirement savings a major boost, and we're going to show you exactly how it works.
So let me just ask you this. What if I told you there was a way to save for your own retirement and get the government to pay you back for it on your taxes? Sounds a little too good to be true, right? Well, stick around because it's very, very real. You see, this isn't some complicated tax loophole. It's much simpler. It's basically a hidden bonus, the government's way of giving you a high five and saying, hey, good job saving for the future. Here's a little something extra to help you out. So what exactly is this reward for saving? Let's get right into it and break it all down. Okay, so its fancy official name is the Retirement Savings Contributions Credit, but pretty much everyone just calls it the Saver's Credit. And its whole mission in life is simple: to give low and middle income folks a direct financial boost for putting money away for retirement. Now, this is absolutely crucial to understand. The Saver's Credit is a tax credit, not a deduction. And you might be thinking, okay, what's the difference? It's a huge difference. Think of it like this. A deduction is like a coupon you use at the store. It lowers the price of your groceries before the tax is calculated. But a credit? That's like a gift card. You use it at the very end to pay the final bill, dollar for dollar. It's way more powerful. But here's the one little catch you need to know. It's a non-refundable credit. All that means is it can reduce your tax bill all the way down to zero, which is awesome, but it can't go below zero. So if you owe $300 in taxes and you get a $400 credit, your tax bill becomes zero, but you don't get that extra $100 back as a refund. Good to know, right? Okay, I can practically hear you thinking, this sounds great, but do I actually qualify? Let's find out. We're going to walk through the requirements for the 2025 tax year right now. First off, there are 3 basic boxes to check. They're pretty straightforward. 1, you've got to be at least 18 years old. 2, nobody else can claim you as a dependent on their tax return. So, if your parents are still claiming you, this won't work. And 3, you can't have been a full-time student for 5 months or more during the year. So, if you clear those 3 hurdles, the next big thing is your income. This chart shows the limits for your adjusted gross income, or AGI, for 2025. Just find your filing status, like single or married filing jointly, and then find where your AGI falls in that column. And boom, that tells you your credit rate. It could be a whopping 50%, 20%, or 10%. As you can see, the less you make, the bigger your reward.
So where do you need to be saving this money? Well, the good news is, it's pretty much all the usual suspects. Contributions to your traditional or Roth IRA, your 401k at work, a 403b, even an ABLE account. They all count.
Okay, listen up, because this is a really important detail. The credit is only for new money you put in. So if you're just moving money from an old 401k into a new IRA, that's called a rollover, that doesn't count. It has to be a fresh contribution that you made during the year.
All right, we know what it is, we know who can get it. Now for the really fun part. Let's run the numbers and see how much you could actually get back in your pocket.
The magic number you need to remember here is $2,000. For a single person, that's the maximum amount of your contribution the government looks at for this credit. And if you're married and filing a joint return, that number doubles to $4,000. And just to be super clear, even if you are an absolute rock star saver and you put, say, $6,000 into your IRA, for the purpose of this credit, the calculation is only based on the first $2,000 you contributed. You know what, let's just do a quick example to make this crystal clear. Let's say we have a single person, their AGI is $25,000. They've been doing a great job saving, and they put $3,000 into the Roth IRA this year. Okay, step 2. We take that $25,000 AGI and we go back to our chart. For a single filer, that income puts them squarely in the middle tier, which gives them a 20% credit rate. Simple enough. And now we do the math. We take that maximum base of $2,000, we multiply it by their 20% credit rate, and what do we get? A $400 tax credit. Just like that. They saved for their own future and got $400 knocked right off their tax bill.
And that's the beautiful thing about it. A $400 credit means you literally owe the government $400 less. It is just like getting cash back for doing something you should be doing anyway, saving for your future.
So by now you're probably thinking, okay, I'm in. I think I qualify. What's the final step to actually get this money? It's actually way easier than you might think. When you do your taxes, you just have to fill out one little form. It's called Form 808080. In fact, most tax software will see your income and your retirement contributions and will probably ask you about it automatically. Okay, let's quickly recap the most important things to remember. 1. This is a tax credit, the gift card, not the coupon. It's way more valuable. 2. Your eligibility all comes down to your income, your filing status, and those 3 simple rules. 3. New contributions to almost any retirement account will count. And finally, and maybe most importantly, remember what this is: a reward for being a smart saver.
So, I'll just leave you with this final thought. For a whole lot of people out there, the secret to a bigger tax refund or just owing less in the first place isn't some wild strategy. It might just be hiding in plain sight, in the contributions you're already making to your retirement account. Pretty cool, huh?